Hi there. Today I'm going to be covering ways to mitigate risk when dealing with option spreads. Now, I think option spreads are fantastic strategies. I particularly love put spreads. Really, that's a strategy I've used to build my account. However, whenever you're dealing with options, even if it's selling options, you introduce a significant amount of risk. And the reality is that everyone makes money in a bull market, unless you're short. What separates a proper trader from someone just messing around is proper traders consistently make money, not over weeks or months, but over years. If you make $1,000 in the market and then you lose $1,000 next year, well, you spent all that time without getting a return. And generally, you would have made more money if you simply put it in an ETF or if you left it in a savings account, which is why when it comes to seriously utilizing spreads and getting a lot of money while mitigating risk, it's an important topic, and I see a lot of people misunderstand it and misuse spreads. I realize this isn't the most exciting topic ever, but I'm going to try to keep things interesting and go through in detail and provide a useful explanation. But this whole video is going to assume that you're actually knowledgeable on options and spreads. If you're not familiar with them, I have two videos covering an introduction to options and an introduction to spreads. I'll have those linked in the description below as well as the title card. So let's get into this entire discussion. I'm going to be using Options Profit Calculator. This is a fantastic website that's completely free to use that offers simple, basic calculations for whatever option strategy you want to do. And as a disclaimer, I'm not recommending that you take these positions at all. I'm simply using this ETF and these numbers to provide an example because they're nice and round, not because I think they're fantastic positions. But the first example I want to go through is simply a basic spread on SPY. SPY obviously follows the S&P 500, so it's a great predictor of market health. It's a very useful metric and a very safe ETF generally. And what I have here is a very basic spread, expiring December 14th with our sell leg at 370 and our buy leg at 365. So obviously, that's a difference of $5 times 100. That's $500 you're putting at risk. But you're going to be making $134 in premium, so your maximum risk is actually just $366. And this is what our profit loss chart looks like. If you're watching in the future, dates will probably be different, but today is December 8th. So if we're looking at the 14th, that gets into the weekly option territory. And you can see we're making a fair amount of money for the weekly option. However, let's consider using the same exact strike prices, but moving things out to the 15th of January in 2021. Now we're creeping into monthly options, and as you can see, we make more money using the same strike prices. So we're still putting $500 at risk, but we're making slightly more premium, meaning that our maximum risk goes down. This is what our profit loss chart looks like. But that's the thing. We are making more money. However, it's not proportional to the extra amount of time we spend. Remember, we're playing with a whole month now, but we're not making 4 times the money. In fact, we're not even making double the money. If we go back, we see we were making $134 using a weekly option, yet our monthly is only making us $183. And that's really the first step to understanding risk on spreads. Yes, the most profitable options will almost always be weekly or 2-week options. And the reason for that is you rapidly approach their expiration. So the theta decay is going to be intense on them. They're very quickly going to become either extremely valuable or extremely worthless. With these longer-term options, things are far more uncertain, and it's going to take a while until we get more definite information on whether the option is going to be worth something or be worthless. So while they'll be worth more, when you consider the actual time period and the opportunity cost of selling a monthly versus a weekly, you are losing money or making less money. But if you noticed, our maximum risk went down. And that's the very first tip when it comes to mitigating risk. Stretch out your options. Yes, weeklies are very profitable. They can be very nice, but you are increasing your maximum risk. You're putting more capital at risk. See, both of these, both the weekly and monthly, we're only putting $500 away. And in the case of the monthly, it's slightly less because our maximum risk is lower. So your brokerage won't require you to hold on to that extra few bucks. But the simple reality is that the market evens out over time. If we take a look at SPY, we could see way back here in July all the way to December now. If you were bullish on SPY and it maybe took a dip right here and your options were expiring that week, you would lose money. You would lose that hundreds of dollars that we saw in our calculator. But if you were a month out, it goes up, then we have some ups and downs, but eventually it equalizes out, and your bullish prediction would actually be correct and you would make money. But options aren't like stocks where you can just hold them forever. Options have attached time decay to them. So you can't just be correct on the actual price, you have to be correct on the timing as well, which is why spreading things out over time, if your analytics are correct, you are correct on your bullish or bearish call, this all applies to call spreads as well, then you'll make money. So that's the first thing to realize whenever you are playing this game. Longer duration options are generally safer because things will equal out. Next, let's cover this $500 spread. Let's say you want to put $1,000 into SPY. Well, your buy leg you could reduce to 360. And if we do that, 360, 370, we see that we do make more money. Remember, previously we were only making $134 for a weekly, but now we're making $187 for a weekly. But if we take a look, it's not proportional to our risk. Our risk more than doubled, but our gains didn't double. So having this incredibly wide spread is actually very, very risky. You're making slightly more money, but you're getting way more risk. In fact, it would make a lot more sense to simply sell and buy 2 of these. If we did 2 of these contracts at the same time, our profit would double and our maximum risk would also double. But 366 times 2 is still a lot smaller than $800 plus. And $134 times 2 is much larger than $187. So if you want to put more capital into an option, it doesn't necessarily make sense to just increase the buy leg difference. If you keep extending this, yeah, you'll make more money, but your risk will go way higher, your maximum risk, and you won't be making that much more money. Generally, it makes sense to just deal with more contracts for the spread that you're comfortable with. And obviously, there will be ideal splits, ideal differentials, where you're making the maximum amount of profit relative to risk. So one thing you could do to mitigate risk is to split things up at the strike price. We could do 365 and 370 for this one, but for the next, we could do 365 and 360. Granted, it's less returns because it's farther out of the money, but if you do the math, it's kind of identical to that previous practice, but it's over multiple contracts. Since our maximum risk is $447 and our return is $53. So it's kind of identical to that 370, 360 split. So if we're dealing with the S&P 500 as our example, and you do this 370, 365 split, but you want to mitigate risk, so you also do a different contract, you could do something like the 365 and the 360 split. But as we discussed, that's kind of the same as just opening a 370, 360. It really doesn't make a whole lot of sense, and you're just going to be paying more fees without really mitigating your risk. Instead, we could do 365, 370 like before, but instead of changing our strike price, we could change the date. So instead of doing December 14th, we could do a December 18th with the same strike price. Now, if we play with the 18th, it's obviously going to take more time for us to get our money, but we are going to be making slightly more money than if we just did double the previous contract, obviously in exchange for time. But the big benefit is that we even things out over time as well. An example I like to use that is relevant right now, it just happened, is the market right before the election. If you remember this, we saw massive drops in a few days. The market just plummeted, and most people would probably argue it wasn't a reasonable plummet. There really was no reason for it to collapse that much. And you have to understand that every reaction in the market is an overreaction. That's why prices fluctuate, because there's overreactions that get corrected. And then as fundamentals change, price targets change, there are overreactions, and then there are corrections. If you had multiple contracts expiring on this date, you would be screwed. Although if you split up your contracts, yeah, perhaps one expires in the money and you do lose some cash. But rather than having double the losses, just changing it by a single week would make it so the other one is profitable. And overall, it might be a loss in that scenario, but you mitigated a lot of your risk and you've cut your losses in half. That's why it's so powerful to split up dates and to use longer term options. It might not be that much longer, but like I said, overreactions happen all the time in the market. A single week or a couple days could be all you need in order to evaluate whether or not you want to sell or see if things tick up again, or to just wait it out and wait for the correction. Now, it might not work out every single time, but we do see spikes up and down. So if you combine the strategies discussed before with dealing with monthly style options as well as separate dates, that's a far more reasonable way to actually split up your options if you want to put a lot of capital into a stock. Again, all these examples are a bullish SPY play. And if you want to put $1,000 into SPY, well, rather than doing that nonsense with multiple weeklies, you could do multiple monthlies that expire on different months. So you heavily segment things to help mitigate with risk, lower it. Also, if you really like this sort of content, I would highly appreciate it if you left the video a like and subscribed. It really helps out the channel. Thank you. And one mistake I see a lot of people doing is trying to pick up pennies in front of a steamroller. It's a common expression, but it might not make a lot of sense at first. Let me give an example. You could do this option play, a SPY 320 and 330, expiring on December 18th. It is very unlikely that that would end up being unprofitable. You would have to see a massive, huge dip in the market, which is highly unlikely of a huge ETF like SPY. But you also have to realize that you're putting $994 at risk to make $6. And it's going to be less than $6 because of fees whenever you're dealing with contracts, buying and selling. This SPY 320, 330, it's just ridiculous. You are putting so much capital at risk for a small amount of money. You have to understand, maybe you're selling these weekly and you're getting around $6 each week or whatever. Yes, it's unlikely, but if you sell 100 of these, maybe over multiple weeks or years you sell 100 of these, you make $600, but then one week there's a huge dip. There's this crazy, stupid reaction in the market, and you suddenly lose over $900. So those years you spent selling tons and tons of these really go to complete waste, because a single week wipes out all of those gains and you actually have a net loss. Again, to give an extremely recent example, there was this whole scare with the beer virus. Imagine if you had your options expiring right here. Imagine that. You were selling these way out of the money weeklies, and you'd been selling them for years, making your $6, $10, whatever, and then a single one expires in the money because of some stupid, crazy event that no one was really expecting, and there's a huge overreaction, the market plummets, and even though it recovers within a couple months, it's not a stock. You can't just hold it. It has an expiration date on it. So you get screwed over and lose all that money. It doesn't make sense to put tons and tons of capital at risk for pennies, for small amounts of money. It's just ridiculous. It's not a good idea. Because it is unlikely, but you're not making a whole lot of money, and you're just putting way too many assets at risk, and huge dips can happen. We see over here we had some huge dips. Imagine you made an option around this spike, and then you had a huge dip, you were expiring right here. Well, you kind of get screwed over. If you did a longer play option or segmented things into longer plays, you would still make money or cut your losses way down. So that's why I say don't pick up pennies in front of a steamroller. These are not the type of spreads you want to be making. Now, I know I mentioned before all the examples of spreads I was using were just examples. I don't recommend you open those positions, and I'm not saying they're great positions or anything. I'm just using them as examples because they're real numbers that show and indicate what happened. I can relate these numbers to what actually happened in the market and show you how you can be screwed over. Getting into a sort of personal strategy I might use, again, not recommending it, just talking about more reasonable types of spreads. Tesla is a pretty powerful stock because the premiums on the options are absolutely ridiculous. People have very strong opinions on the stock, and it's a very volatile stock, so the premiums are high, and you can make a lot of money dealing with spreads. A position like 19th of March for 600, 610, this is a relatively reasonable position, because if you look at it, you're making nearly $500. So $1,000 at risk, that's a 50% return. You're dealing with a very long time period, and your maximum risk isn't thousands and thousands of dollars. So hitting that 40% return for the amount of capital at risk is what I really like. And doing it over the course of a few months is my preference. Like this SPY, for example, where we're getting 134 for a weekly, that's almost a 40% return, although it is under that 40% amount, and it's an incredibly volatile weekly. I used to do weeklies a lot, but a single week kind of put me in a vice, and I realized once I amounted the amount of capital I have, it's really not such a good idea to be playing weeklies for large amounts of money. When we actually get into the specifics of how you choose how far out of the money a spread is, or how far into the money a spread is, because you can sell in the money spreads, that sort of gets into all the details of the option Greeks. The Greeks are just the risk factors for options. You have delta, theta, vega, gamma. There's a lot that goes on, and it gets way more technical. I'm talking about general strategies rather than getting into the specifics, but this is an important thing to look up and understand if you really want to mathematically optimize a lot of your options, but you also have to be reasonable on your price targets and analyses of the stocks and assets you're dealing with. Hope that helped, and I hope you guys are out there trading successfully and not putting your accounts in a ridiculous amount of risk. If you want to jump into the stock market and get started trading, Webull is a fantastic brokerage option. If you sign up using the referral link in the description below, you'll receive 4 free stocks. 2 of them will be valued between $2.50 to $250, and the other 2, as part of the deposit bonus, will be valued between $800 and $1,600. That's $2,100 to $3,700 just for signing up. Again, the link is in the description below, and happy trading.